All right, welcome. What's going on here? This is basically we're trying to figure out why is the market selling off, right? We do have quad witching today, so a lot of options expiries, a lot of selling in the market. Uh, but the S&P actually bounced. So what I wanted to focus on is some of the macroeconomic data that just came in. So keep in mind this, right? Going forward, the GDP estimates coming from the Atlanta Fed have now gone down. You can see here they got up to almost 6%, back down, right? So now growth is at risk. Is growth at risk here? Are we losing GDP? Is GDP coming down? Is that bearish? Are we going to collapse? Are we going into a recession? Next, well, China cutting rates again. China reliquefying again. Not so significantly, but they're doing whatever they can to cut rates here. So this is just the Public Bank of China require reserve ratio for their banks, for financial institutions. They're easing. Let's just put it that way. All right. Also, we got Chinese retail sales. This was yesterday, but we didn't talk about it. Up. Retail sales up better than expected. And so China is not collapsing as you might be hearing. Obviously, UAW's been the big report. Is this going to cause supply side inflation, right? People are, they want their wages higher. Is this going to cause wage inflation to rise? I think it gives advantage to Tesla. And so we're going to keep our eye on that. Well, there should be a deal by the end of this weekend. That's my understanding. That's what I'm guessing happens. You got a deal last time with UPS, right? You should get one here. Now, the BLS, the labor of the Bureau of Labor Statistics, is showing here, right, going into 2023, that we still don't have a strong enough labor force. We still need more people to come in, right? I think this gets solved by tech, but the whole issue here is these are a bunch of bearish sentiment. Everybody's bearish, right? If you go down to it, GDP is coming down, China falling apart, right? There's not enough capacity for oil. Oil is going to keep getting cut. Chinese retail sales, that's kind of bullish, but you would say, oh, they're falling apart. UAW is going to cause supply side inflation. There's not enough workers in the economy. We're going to see wage inflation, right? That's the idea here. You have looking at for the next Fed meeting, right? The Fed's going to determine everything. I'm going to show you why the Fed's decision is going to move the bond market, is going to solidify and confirm what stocks actually do here. So we have the Fed is done. Morgan Stanley, Goldman Sachs, they believe the Fed is done hiking. Okay. Big banks there. But Citigroup, Bank of America, one last hike. And maybe that hike, I don't think it comes in the next 5 days here in September. But if it does, there's an idea. We go through October, we look at the data, and then November they hike again. But they're not going to hike, right? They don't have the meeting before the inflation. After inflation in November. It's before. It's like November 1st. So they could pause here just to hike within the next, it would be like 3 weeks, right? Within the next 2 or 3 weeks. So I think that's what's going to happen. We're going to get a pause and then a possible hike looking at the next 2 weeks. So what I wanted to look at here, what I wanted to focus on is, the next Fed meeting. Oh, well, not this one. The next Fed meeting. So it's really questionable here, right? Is the next Fed meeting, I think it's going to be unique because we're going to find out whether these oil prices, if the Fed's going to respond to them. Is the Fed going to respond to these elevated oil prices? That's what we need to figure out here. Is it transitory? Is it stagflationary? Is oil somehow doing the job of the Fed by tightening conditions, right, for consumers? Very confusing. And so we definitely want to keep our eye on the next Fed meeting. I think this is going to be probably one of the most important Fed meetings, specifically because how are they going to respond to oil spiking, right? Dollars going up. How are they going to respond to that? So first, a lot of people think this is the 1970s, right? We're looking at 1970s reflation back to the highs. Inflation's going higher. It's going to make new highs. And I just wanted to, point this out as we think about this, right? So in the 1970s, the Fed chased inflation. As inflation peaked, the Fed cut aggressively, chased it back up, back down, shaky Fed, shaky market. So basically what kind of what's going on here is this is not the 1970s because the Fed's policy was much different than the 1970s. In the 1970s, when inflation went higher, the Fed hiked rates just like they did today in this era. The difference is they chased inflation down. They started cutting rates, right? When inflation peaked, they cut rates. Even before it peaked, they cut rates, right? You can see right here, these are the swings. So they hiked rates kind of like today. They cut rates on the way down, which eased the markets again, which eased financial conditions again, and you get this reflation. Okay, you get reflation happening again. Inflation goes up again. They have to start hiking again, right? So they're chasing inflation instead of holding strong the way they are today. So you get that shaky Fed, you get shaky inflation. This is not the 1970s. Does not look the same, right? So the Fed kept hiking, kept rehiking. They didn't hold, right? That's the idea here. They kept rehiking. They did not hold rates in the 1970s. Totally different regime, right? Totally different regime. Even though they say, oh, it looks like a 1970s, the Fed was literally easing, pushing liquidity up while inflation was, falling. But it wasn't. We all know inflation takes time, so it's not the same. It's just not the same. Now today, the Fed is actually holding rates higher. Rates are in very restrictive territory. The Fed is focused on core, which is falling. So that's kind of what this is showing here. This chart, and this will be on Twitter. And really, it's like, are we in a boom? Are we in a bust? What's going on here? Today, it's much different. When inflation peaked here, right, the Fed did not cut rates the way they did in the 1970s. In the 1970s, they cut rates. Today, they did not. They held rates, right? You see, as a matter of fact, this was the strongest hiking that the market had ever seen. Very restrictive territory. That's where we're holding. Core is still falling. So we're getting CPI headline move up. You're getting that move up in headline CPI, but typically it just goes lower. So you're going to need something to really push that higher and sustain higher. Is it oil? Maybe. Maybe oil is the black swan here. We are in the peak for this and next year. Yeah, that's what I think too. BTC 2030. Are you looking at that $1 million Bitcoin, aren't you? So, and then let's dive a little deeper. So the market soared when the business cycle bottomed. This is the 1970s. What actually caused the market to bottom or to start soaring higher, right? We don't have crypto. We didn't have crypto back then, but this is all risk assets. These are markets in general. What caused, stocks, equities to soar? Right? Well, this is what I'm trying to point out to people is this is not the 1970s because the Fed's response is much different. They're holding rates every time that they signal, hey, we do not want to risk cutting. We don't want to risk inflation reemerging. They're basically saying, hey, we're not doing the 1970s. We're not going to cut rates as inflation falls. We're going to hold it there and make sure it bottoms out. Make sure we get that pressure down. They don't have to increase rates to create pressure. They can just hold it there. That creates pressure in itself. Okay, so the real question is, well, where are we in the cycle? Where are we in the cycle? Well, what's going to get stocks to go to all-time highs and break out again? Okay. And I think we're getting near to that. I've been saying this for a while, but here's what we saw. Stocks soared when the business cycle bottomed and inflation made new lows, right? So what do I mean by that? The ISM manufacturing, you can see, is very cyclical with the S&P. The ISM is very cyclical with the S&P 500 because it is GDP pulled forward. It's what you're going to get in GDP. GDP is a backwards-looking data point, right? When you see GDP or unemployment, or not unemployment, unemployment, GDP, those are lagging indicators. The ISM, the business cycle, these are leading indicators because you're looking forward at new orders, employment, all that stuff, right? So when this bottomed after this whole inflation event and CPI actually made a new low, I think this was like 4%. So today that would be like 3%. Once CPI breaks lower to a new low and you get the ISM bottoming, you see the stock market soared. The stock market took off, right? And I think it's not going to happen the same way. They say that things don't repeat, but they rhyme. And I think it is going to rhyme going forward. And there's a lot of reason for that, which we are going to go over, right? So today the ISM is bottoming, right? That's what we're pointing out here today. The business cycle, right, which is driven by the ISM, that's starting to bottom out here. You got to keep that in mind. If the cycles are always, if the business cycle or the ISM leads, the economy, and you're hearing recession, we're going into a deep recession, maybe next year, maybe in 2024, but to close out this year, we're actually getting manufacturing turn up, right? So you're getting the ISM bottom, which is one factor to the market breaking out to all-time highs, right? Whatever it is, crypto going up another 20, 30%, despite the ETF, because you're getting liquidity come back in, right? So you're getting the ISM bottom. And the next question is, where's the new low in inflation? What's going to get the market to get, because a lot of people are on the sidelines, right? A lot of investors, fund managers, and professionals, they're waiting on the sideline. They're just wait and see. Let's see what happens here. We want to buy a new low. Hasn't been put in yet. And we're going to go over the technicals. And so core is falling though. So right here, core is falling. And the difference between today and, in the 1970s, the Fed is focused on core inflation because it's more systemic, because it's housing, because it is wages. It's more focused on that, not necessarily energy prices. They're not chasing oil here. I could be wrong. Maybe if oil gets above 120, maybe above 100, the Fed reacts. That's what we're going to find out here September 20th, is whether how much the Fed cares. How are they thinking through? How are they justifying a holding or hiking rates, or their speech dovish or hawkish in the face of oil? Because we know core is falling. Core is coming down. Super core is coming down. So, this slide is basically just pointing out, hey, the business cycle we have the business cycle on our favor in the short term. Maybe it turns back down, right? Maybe it does turn back down, but manufacturing is turning up, and that's probably from the fiscal policy. Okay, so when do we get headline inflation back below 3%? It's not going to happen anytime soon with oil prices at 90, 92. It's just not going to happen because it's headline. But core breaking below 4% could reignite the market, because we know the market is not responding to gas prices right now. It's just not doing it. Okay, when it does come, it comes. Now, the second part here is the Fed, and if you want to see the charts, they are on YouTube here. The second part here is the last Fed pause, because a lot of people say a pause is bearish. I'm tired of hearing this. If the Fed pauses, very bearish for the market. If the Fed pauses, right? Markets are going lower. That you see all these graphs, all these charts showing that when the Fed pauses, things go lower. That's not necessarily true at all. That is not necessarily true at all. There are other factors like business activity, where the market is, positioning, all that stuff goes in an account. And this is all bundled up in these couple of charts on my Twitter. That's why you must run to no, I'm just playing. You don't have to follow me on Twitter, but that's why I bundled these up. These will be on the newsletter, by the way, if you want to check it out. Okay. So what we're looking at here is the last Fed pause, December of 2018. I remember that. I talk about it all the time. I remember December, it was near Christmas. I was long Facebook, and I was getting crushed. I didn't know what I was doing. I was a new investor, and I was like, what the hell's going on here? Why did the stocks keep falling? And then Jerome Powell came out on Christmas Eve and said, we have decided to stop increasing rates. And so the S&P moved up 39%, somewhere around 39, almost 40%, right? And this is 2019. This was 2018 going into 2019. I'm sorry. Yeah, 2018 going into 2019. He paused and the market roared, right? And then they did cut. So again, kind of zooming in here, maybe I should just click on it. It'll be a little easier to see here. Yeah, I think we got everything. So basically you got the pause in 2018 of December, which was really 2019. You got the pause. The market bottoms here. This was the bottom of the market. The Fed paused. Oh my God, the pause is bearish. No, it depends where you're at. It depends on, are you at all-time highs? Are you at all-time lows? How are people positioned? What is the sentiment? And right here, people were negative. He pauses. Boom, you increase liquidity, right? You stop tightening in a sense. The market goes higher. They start cutting, right? What is this? 2020. They start cutting in late 2019, mid 2019. They start cutting rates. Market goes higher. Now the market's up 39, 40%. And this is where everybody targets. This is where everybody, all the bears, point out that rate cuts are bearish, because what they're looking at, damn, I need some water. What they're looking at is the pandemic. Well, duh, the Fed cut rates because the whole economy shut down. That's why that was a bearish reaction. But they don't tell you about 2019 January or 2018 December, when they paused and the market roared for the next 8 months, 40%. They don't talk about that part, right? So that's just false information. Oh, you want to talk about 08? Okay, we'll get to 2008. Let me get out of this picture. We'll get to 08. Hopefully, don't get lost here in my own charts. All right. So yeah, let's go to 2001, 2008. I'm just going to read it. Typically, cuts are bearish. Okay, and we talked about this. Rate cuts are bearish when markets are at all-time highs. Because why is that the case? Because investors are overweight. Most of you are not overweight. Maybe some of you are, like me. I'm overweight. I'm going to be honest. That's why I want the market to go up. Obviously, I don't want it to go lower, but I know that. I understand my bias, but I also know that other people are underweight. And I'm overweight because I was bullish back in October, November, December. If you watch my content, I've been bullish for a long time. And so that's why I'm overweight. And I think this rally does continue. We do have some headwinds, but the point here that we're talking about is typically cuts are bearish when markets are at all-time highs, investors are overweight, while the ISM PMI, while the business cycle starts to contract and go negative. We are not there. Right now, everybody's underweight. People are waiting on the sideline. They're waiting for a crash. They're underweight stocks. They're underweight risk. And the ISM is bottoming. The business cycle is actually starting to turn up, complete opposite than 2001 and '08, right? And this is the chart, so you can see that. Or you get a black swan, right? If you get a black swan, it really doesn't matter. You're probably going to get a flush lower. So when stocks are at all-time highs and the business cycle is turning negative, rate cuts are bearish, right? Here are the rate cuts in blue. Okay. And what I'm showing here is this is the ISM in orange. This is the business cycle in orange. This is the stock market in white. And what you get is all-time highs. Markets are at all-time highs here. The ISM starts to go negative. It starts to go in contraction territory, which is signaling recession. And then the Fed cuts rates. Okay. So the Fed is cutting rates because growth projections in the future are lower. And the market is all-time highs. Everybody's overweight. They're like, oh, shoot, let's sell. We're starting to cycle back down. Lost 4K today. Oh, you lost 4K today. I lost 4K today. You try to go long or what? 10%, 10, 15% more downside S&P from here over the next 6 months. Bob's, come back on. Come back. Are you Italian, bro? Come back on here and let's talk about that, because the market is not going down for the next 6 months. It could go sideways, but I doubt it. Anyways, yeah, that was 2001, guys. Also, you had a black swan. You had a black swan. So not only did the Fed cut rates, it's not negative. You're easing conditions. The market can bottom on rate cuts, but at the same time, you had a black swan. It was 9/11. 9/11 hit. It's risk off completely, right? That's complete risk off. Okay, let's move over to '08. They hike rates, right? We're nearing 2008. Same thing happens, right? Same thing happens. You get the Fed. You get the market at all-time highs. For one, markets are at all-time highs. Overweight. Everybody's overweight. Everybody's, you know how it is. If you're up a lot and you hear something negative or something goes bad, you're going to shave some off. But if you're not in the market at all, or you're underweight, you're more likely to want to add risk when you see things starting to go up. So this is not the same cycle. So 2008, markets are at all-time highs. ISM business cycle starts to go negative, starts to contract. The Fed starts cutting rates. Something breaks. So something did break, but you already had the ISM going negative and the market is all-time highs, right? So that's the depiction here. We're not in that cycle. Markets are recovering. We're not at all-time highs. Maybe when we get there, but the other part is people are underweight. They're not overweight. They're underweight. And the third part is the ISM is actually turning back up. So this is a bullish setup, right? But things are a little shaky here, because what the hell is going on here? And this is why I say what the hell is going on, because oil is breaking out. It's up 40% from the lows, 8% from the 83.50 level that I said was risk off. Yields are not significantly responding. We're going to go to that. Yields are not really moving up that strong. They're barely moving. Yields are not responding. Okay, why is that? Bond volatility is making new lows. What is bond volatility? That is the confidence in the bond market is improving. If volatility comes down, just like the VIX, confidence is actually improving. Okay. And here's why I think the RRP cushion, the reverse repo facility money, that cushion continues to support liquidity, which I've been saying this over and over and over. This is the key here. Liquidity is still coming in, whether it's to suck up the treasuries that are getting offloaded by the treasury, or whether it's going into some risk, which it possibly is, because you're looking at the UAW strikes. You're realizing if they increase wages, GM, Ford, Stellantis, who else? All these auto companies can barely afford debt today. Now they're going to lose it. So where's the risk going there? The risk is saying a couple of banks are pulling out of lending to auto manufacturers, and they're going to Tesla. Oh, that's super bullish. Yes, it sounds crazy, but this is how you see a catalyst ahead of time. The auto industry is in trouble. Other than Toyota, the auto industry is in trouble, and there's tax credits going towards EVs. The average price of a car is $45K in the US. The average price, right? Oh, you want a low end vehicle? Well, guess what? Now Teslas, if you get the tax credit, if you get the rebate, you're looking at a $28,000, $30,000 Model 3 in 2024. While oil prices are up. So anyways, getting back to the story here, the reverse repo facility is creating a cushion. There's no credit risk. We're not seeing triple V spreads rise. There's no put buying either. So you would expect this to be negative. Today is triple witching. That's why we're low. That's why we're down. Everybody, you get one red day, all of a sudden people are hyper bearish. Again, throw your comments on the YouTube if you guys don't mind. Oh, there, we got some comments. My bad. We'll get back to that, because I can't see them on TikTok. It gets lost in the feed. I say that all the time. needs liquidity. Buyers and sellers don't be liquidity. What's up? What up, Ace? Ace, don't, if you don't mind jumping on there, I want to hear your comments. What you got to say? Jumping on the YouTube. Oops, I lost 4K. Okay, the market needs liquidity. Yep. I think it's getting liquidity, bro. Make a jump to image makeup. Oh, you're talking about the images? I don't know what's going on. Jeremy feels like the top was set. Jeremy feels like the top was set. What do you mean by that, Demiush? All right, so let's keep moving on here, and then we'll get to the comments. And also, anybody wants to go live, let me know, and we can talk about the market here. Next, look at this is what I mean by the economy. You're hearing that we're headed into recession. It is not happening. We're in a rolling recession, in my view. There is some weakness. Financials are weak. The housing market is still weak. The housing market might, roll back over. We'll see how that plays out. But if you look at the regional PMIs, which are the purchasing managers indexes or business activity in the US, if we look at forward-looking indicators for macroeconomics, they're all starting to turn up. This is what this is. These are the regional. We've been in a recession for a while. Now, the red one, right? The red one is the Chicago PMI. That one needs to get above 50. So it's headed there. So these are two different charts, but Philadelphia and New York for the first time, they're starting to consolidate here. So what you're seeing is that business activity is picking up regardless of what you hear. It is picking up regardless of what you hear. Okay. Next, inflation expectations going lower. How the hell is that the case if gas is going up? I don't know. This confuses me too. But what I think here is we might be seeing expectations anchored to core inflation, not energy. Even though energy does affect the consumer, which is going to slow the consumer more than anything. I think they're going to, probably stop their spending is going to get sucked away from retail sales, stuff that people don't care about. They're going to have to pay more gas, XYZ, whatever. But growth doesn't really collapse anywhere. Okay, so you're seeing expectations in red is 1 year. I'm sorry, red is 5 years, next 5 years. Blue is next year, next 12 months, right? Those are below 3%. So expectations are actually getting better here, right? And then you have China still easing. They will continue to ease. You've heard me say this multiple times. China's going to keep they have to do it. They have to do it. They're going to sacrifice the yuan to some degree, but they're going to have to do it. All right, so carbides. And I'm going to jump over to the charts now. Let's jump to the charts. 10 to 15%, in my opinion. 10 to 15%. Fed pauses and gives guidance about no more rates. Huge rally. Yep, I agree. That's what I'm waiting for too. The Fed could pause and not give guidance on a pause. He could pause. My guess is that next week the Fed pauses, but they say we could still hike. They're not going to say it's over. I think they're going to say we can still hike. The more likely scenario now that oil's up, for me, the way I'm seeing it is that they pause and then all of a sudden November, they take October off, they come back in November, they hike another 25 basis points if oil keeps surging. If oil sells off, maybe not. But it's going to bring up the CPI a little bit on the core. Here's the thing about core. For every 10% rally in oil, and you could fact check me here, I just heard this from a couple of people, every 10% rally in oil, supposedly you get 300 basis points in the CPI, which means if you're at 3.3, you're going to move to 3.6. That's kind of what we saw, right? Except for it was more of a 17% rally. So you're going to get 300 basis points or 3/10 in the headline. But when it comes to the core, it's 30 basis points, which is a 0.03 increase, which does nothing. So core going nowhere. Core is going to keep falling, right? And then you said Fed raises rates, sell. Yeah, if Fed raises rates, we're going to sell off. We're going to sell off back to 4. I think we go back to 431. Okay, so Jeremy who? Yeah, I don't know who you're talking about. Yeah, we're wedging for a while. We're still in a wedge. We're still holding the uptrend. I got burnt before on the same exact setup. I promise never again. Ace, you got burnt going short. Were you going short? And look, the dollar is at resistance here. Actually, let me get the full chart. You guys can probably see it. The dollar is at resistance, right? So this is we're either at a breakout point where the dollar, like technically the dollar did break out. Okay, it did break out technically. Okay, risk off, but the market isn't really responding too much to that because now the risks of recession are starting to disappear. Even though you're hearing the opposite wherever you are, that's not happening. You're actually getting the business cycle bottoming. All the near term data is showing Oh, we're weakening. Yeah, of course, consumers were pretty strong. We're weakening a little bit, right? GDP revised up, now it's getting revised down. But at the same time, the business activity in the US in some areas it's kind of rough, is still picking up. So maybe it drags. I'm thinking if we get recession at all, if unemployment gets above 4.1, 4.2%, and GDP, I don't see GDP going negative actually at all. There's too much fiscal policy. There's just too much fiscal spending happening for you to get that. But you could get unemployment go up a little bit, right? What else? So maybe in 2024, maybe you get a shock in 2024, but you need oil to keep surging. Oil has to surge around these prices. It's up a lot, but if oil comes down back to 80, 75, nothing, right? Not really a big deal. Um, how can we get out of recession? Well, the way we get out of recession is typically uh the way you get out of a recession, I mean, it's like a tier system. Business activity needs to get back above 50. Right now, services are leading the economy. Services are in expansion territory, right? So services never went into recession. That's 70% of the economy. Manufacturing has been in recession, but it's still now starting to bottom out. So we're starting to turn back up in manufacturing. Maybe we don't get up to 50. Maybe we stay in contraction territory for a little longer. That means we're still in a rolling recession. We're not in a widespread recession. We're not seeing that. That's just not the case, despite what you hear. We're not in a widespread recession. That hasn't hit yet, or else you would see unemployment spiking, you'd see GDP going back negative, and you would see a lot of other indicators happen. That's not yields would be coming down. Bond yields would be collapsing. Not the case, right? Part of the reason that bond yields are so high is that there's a lot of supply on the market coming in, and the growth prospects just never fell apart. You're right. Earnings for stocks going up. Oh, Mag 7. Yep, Magnificent 7, probably. So how do we get out of recession? Basically, you need the housing market to recover, but you need rates to come down. But for rates to come down, you need the Fed to pause, to announce the pause. And we're in a rolling recession. We never got in a deep one. So to get out of the rolling recession, you need the Fed to pause, to be confident. You need oil not to keep surging, maybe stay. But look at oil strong also really is a signal that we're in an expansion. Oil does not surge. Well, it is kind of supply side, so it's kind of tricky there. But oil going up is not a great deal. It's not a great deal there, but it still signals like you're not getting a collapsing growth. So you're in that sweet spot between recession. Inflation is not going higher. It is not going higher unless oil gets above 100 and explodes, right? That's the only way, because you're getting more productivity, and all you need is more production, more activity in supply. Who knows? OPEC could be trying to crash the market. Is OPEC? That's another question. Is OPEC trying to get the Fed to hike again? But then that would crush their earnings. That would crush demand. So I don't really know. We got to wait and see. I kind of don't know what to say about oil at this point. But what I will tell you is that the way the market is responding is it doesn't care too much. Not yet, anyways. That could change quickly. Hey, thank you for the videos. Oil shot up in September. Yeah, oil started going up. That's why I said, hey, this is risk off for me. When oil goes up, I'm not too much risk on. The difference is that the RRP, check this out, right? S&P 500. And today we also got a nice bounce. I'm going to get to your comment, Carbides. S&P 500, yes, it pulled back, but we're still holding 444. That is the level. Oh, never mind. We dropped 444. So we're in the sweet spot. We're at the previous low, right at the low, 443. So we're slipping. We're slipping a little bit, right? We're breaking this wedge. So we're more so probably about to sell off here. If something bad happens, but we all know the catalyst is the Fed. What are they going to do? Next, the RRP liquidity continues to come into the market, right? The reverse repo continues to rise. This is the cushion that's keeping markets liquid right now. Do you think I can send a link here to a trading view chart of SPY with the possible pattern that I see? Yeah. Send a link. I should be able to copy it and check that out. Send a link on their Carbides. Yeah, I want to see that. I want to see your oil is very inflationary. Yeah, oil is inflationary. I mean, it is inflationary. The question is, does it doesn't it oil go energy is inflationary, but you just have oil. So yeah, oil alone is the biggest, most important commodity. over 83.50 could be inflationary, but everybody thinks this is 2020, 2021. The reason why oil was so inflationary in the earlier years, there was no supply chains. Remember that. Supply chains got wrecked, Fibonacci, Poppy, Ace. So there was no ability to convert the oil. I mean, it costs more to literally get oil. Where in this case, it's not supply chains being broken, it is OPEC literally reducing supply, right? So it's not systemic. It's more so they're like a central bank of they're the they're the central bank of oil right now. But you have other suppliers coming online. I also happen to think that this oil breakout is a trade also, because what do? They keep saying we're cutting all the way into December. They keep saying that. So it could become an issue. We'll just keep it monitored. We'll monitor oil. It doesn't really move up core. It doesn't make housing prices go up, which the Fed is concerned with. So yes, it could be inflationary, but only to the degree that it, like non-energy, not really in non-energy, right? So housing doesn't go up, wages doesn't go up. Those are the more structural things. Energy is how do I say this? It's wild, right? It's volatile. That's why they use core, because they want to take out the volatility. Because then what did they do in the 1970s? They chased it. As soon as oil fell, they started cutting rates. So the Fed doesn't want to chase inflation up and down. They want to focus on core things and just hold it there and keep the pressure on. Because the again, like I said, when oil fell like a rock, what if the Fed would have cut rates? When oil collapsed, right? Let's go to the oil really quick. When oil first collapsed, what if they would have started cutting rates here because CPI peaked? All of a sudden you cut rates, inflation comes right back up. So my point is, yes, oil's inflationary, but the question is how high, at what point does it become super inflationary? And then also at the same time, does the market care unless the Fed, right? Pausing. Like if the Fed pauses, it doesn't make oil go higher. If the Fed cuts, it doesn't make oil go higher. If the Fed increases rates, it doesn't make oil come down either. They don't really control oil at this point. So yes, it above 100, it's like, damn, how high does this thing go? So we'll keep our eyes on that for sure. Also, you're gonna get Exxon Mobil and a lot of those companies, really go up in earnings. So we're at we got here quick. We're at 92, 93. That's an issue there. Monday going to be down. I don't know. I don't really know at this point. I would say we'll look at the data, but the market is looking at what the Fed's going to do, and it's pricing in a pause. If that's the case, like I said, going to S&P, I think they are going to pause, because this signal from the RRP, like we'll get into the RRP leaving. These guys are smarter than us. What that signals is somebody smart who messes with the bond market or is in the Fed. They're leaving the Fed. These guys are leaving the Fed. Because the only reason to leave the Fed is if you think they're going to pause. And if they pause, you're not getting the same, you're not going to get the same risk reward on holding money at the reverse repo at the Fed funds rate. So that this signals to me that there's going to be a change in policy pretty quick here. Why was stock market down today? Triple witching. It was due for a pullback. First of all, number two, triple or quad witching, which is when a bunch of options expire. That's why it was such a sharp sell-off. There was no real catalyst, if you think about it. There wasn't a real catalyst. It was triple witching. Somebody called it out the other day. I said I didn't think it was going to be that serious. It was a little bigger than I thought. Let me see. Did the Qs bounce? Qs didn't bounce. But we're not making new lows. So it's not like, it's not like crazy bad, but it was a stronger sell-off than I thought it would be. I was wrong about that. I thought quad witching wouldn't be that big of a deal. It was. But again, it's not a macro catalyst. It's just quad witching. Options expiring. After it being up for 2 days. Why was stock? Oh, yeah, that's why. So look up quad witching. It's hard to explain. It's just options expire. People's, it's automatic selling or buying, or your contract changes. Okay, so carbides. It could also be head and shoulders still, even if the right shoulder is higher than left. True. All that matters is that it's less than the head. Symmetrical triangles capture the head and shoulders. All right, so we got some bears here. Well, I don't want to say he's a bear, but he's pointing out the head and shoulders, which we watch. We'll look at this. He's looking at the head and shoulders. Pretty clear here. Let's do the head and shoulders. We got again, if you guys want your comments to stick, go to the YouTube, That's where I can actually see them stick. They get too lost in the damn TikTok feed. Pisses me off. They should have a join on the right hand side. I don't want to see the damn join. I want to see the comments. Anyways, if you want them to stick, jump on the YouTube. It'll be a lot easier. Subscribe also. Help me out with the algorithm. So here's the head and shoulders. Boom, boom. Here's the next one. If the shoulder's lower, if you get a lower shoulder over here, it's more likely the probability increases the head and shoulders. But so this is less likely of a head and shoulders because the shoulder's higher, but it doesn't eliminate that. Again, technicals don't tell the story. So what's going to make this head and shoulders really become nasty or really become bearish is going to be, yeah, there we go. I want the smaller one. It's going to be if the Fed hikes. If the Fed hikes, which I don't think they do, or they say we're going to hike in November. I got to see what what the market is pricing in a second. If they do hike, boom, this thing is going to follow through. We're going back to these are the Qs, 355, possibly even lower but I don't think we go lower. I think we just go back to 355. There's still a lot of positive catalysts here. For S&P, pretty much the opposite, right? S&P collapses. S&P collapses here on the head and shoulders. And I know that's a lot of writing there, but we have the shoulder. Ooh, what's going on? The hell? Ooh, my computer's overheating. Too much talking. Let me remove this. Thinkorswim taking up a lot of room. That's stupid. Anyways, you got the head and shoulders. If S&P breaks down, it's going about 438, and then at the lowest 431, which is down here, right? Which is right about down here. Let's see if I can redo this. That's annoying. Take off Twitter. Anyways, back to your guys' comments. There is no data coming on Monday. Yeah, I don't think there's any data. Can you do meta technicals? Oh, yeah, I can do meta technicals. Was it a higher low today, and how will it perform next week? Okay, you're talking about meta there, right? I'll pull back on the charts. I just had to reload it. Probably have too many things on here. So I wanted to look at the Fed hikes really quick too. The market is pricing in the Fed pause. Okay, we're looking at a pause. 99%. This is the highest probability. If this changes, the market's going to get ripped. Okay. Oh, let me show it. As you guys can see on YouTube. So well, this is the biggest swing right now. I haven't seen this all. Actually, I don't remember this all year. There's a 99% probability that they pause. Somebody knows something. This is a lot of confidence. Somebody knows something. RRP liquidity leaving the Fed, they know something. They know the Fed's going to pause. The real question is, do they hike in November? That's the real question. I don't think nobody knows. If we move over to November, there's a 73% chance. I think this is the next, everybody agrees they're going to pause. This is the next, volatile decision, or the next drama is, will they hold here at 525.5, or do they hike? Right now we're at 26%. Is that up or down versus the last month? Last month, the chances of a pause were at 61, 53. So this is the highest. The market is pricing in a pause, even in November. I think the market might be pricing in this is it right now. They're pricing in this is it for the Fed. So really, it comes down to oil. I want to hear, what do they say about oil? How are they going to respond to oil? It is naturally every winter season to run your car, heat your home. Oh, yeah. Natural gas spiking would be negative. Nat gas is still low. We'll see how that plays out. Nat gas is a big factor. There's no way we're pausing. Okay, Ace says there's no way that we're pausing. And I'm guessing your view comes from the fact that CPI is up right now, right? CPI is up. So really, Ace, my thing is, if the Fed is focused on core inflation, housing coming down, then they can pause. I mean, the market's pricing it in 99%. So that's the market. I'm going to go ahead and go with what the market is pricing in. It's pretty, those people are smarter than me. Yes, I'm going to look at Meta. All right, here we go, Meta. So that's what the market says, is that we're going to pause going forward here. Also, you have financial conditions tightening. You got to think about this. Oil going up and the dollar going up, they do the Fed's job, and yields are holding higher. that's tightening the market for the Fed, right? They don't just hike rate. They can't knock down oil by hiking rates. That's not going to change oil. Housing prices go up, yes, because of the contracts, because that literally has to do with rates. So I'm going to disagree with you there. I don't think there's no can they hike? Sure. I don't think there's no way they don't hike though, just because oil's up. That's why I want to hear what they actually say going forward when it comes to that. All right. So Meta, look at Meta here. You're expecting November pause. Maybe you're right. Maybe they hike and then they pause in November. Maybe that's the case. Um, I've thought about that too. Nobody knows, but the market is pricing that in. So Meta, let's look at Meta technicals really quick. If you're talking about Meta lower high, Meta is on a lower high, but it looks like a wedge to me. Look at Meta is one of those companies. It's a part of the gig economy. Okay, Instagram models, products online. This is where people are spending. They're making a lot of money, even though the you start to slow. You guys already know OnlyFans, all this crazy gig economy spending online. Meta's going to benefit from that. So, unfortunately, that's just the case. I mean, and when I say unfortunately, because a lot of it's stupid spending, you know, but it is what it is. So I think Metas can retrace and it'll be fine. But again, you're looking at the overall market right now. The most important thing, look at this wedge. This looks very bullish to me when I look at Meta pulling it from the lows, right? I actually want to change these to, there we go. There we go. Let's get this to dash. I want to get this to a dash. So yeah, I think Meta's setting up for a breakout at some point, but you got to watch the cues. The cues are at support at the point at right now. And I don't know Meta earnings, how they're gonna do, but Meta typically just takes a while, but when it runs, it runs. It could be resting. Um, it looks very this is a bull trend to me though. Meta's still in a bull trend. Your next resistance is it filled that gap. Your next I mean, over 330, it's going all-time highs. I think this next run is going to all-time highs. If the Fed pauses, right? If the Fed pauses here in September, if they ever say we're done hiking for now, if they say that, the market's going to rip because the bond market's going to ease, the dollar's going to come off, oil might just keep going higher, right? So oil might keep going higher. Who knows? Maybe oil is the only thing that tightens conditions because oil going higher still hurts the consumer, right? If you have to pay higher gas prices, you're going to stop spending somewhere else. You're going to look twice about your food, or look twice about going to that restaurant or even traveling, right? So oil going higher also tightens financial conditions. The question is it systemic? Does it leak into non-energy stuff? No, it doesn't, right? Uh, you just think we're early. Okay. We'll see what happens. I mean, we're going to be live on it September 20th. I believe it's the 20th. Tell me if I'm wrong. I think it's the 20th, but yeah, they might be there. I'm not expecting a hike. I'm bullish. If we hike, I got to remember to throw these on here. So this is carbides. Yeah, I'm not expecting a hike. I'm bullish. If we hike, we will sell off hard. I agree. If we hike, we sell off. So your Meta, if we do hike, expect Meta to come back to like 280. I'm thinking about 280. It comes back. But again, 25 basis points isn't that big of a move compared to what we've already seen. Okay, it's not that big of a move. Also, they risk KRE. Here's another reason I don't think they hike. Wall Street knows what's going on here. KRE is not falling apart. So there's a signal in the market that says the Fed is going to hike today. I mean, I'm sorry, it's going to pause. KRE are the regional banks. If they hike, they're putting more pressure on these regional banks who hold mostly commercial real estate, which is already at risk and probably going to collapse at some point in the next 12 to 18 months, which will start a recession in the real estate market, at least when it comes to commercial, not really residential. And that's going to be an issue. But right now, KRE is not responding that way. And trust me, these guys know what's going on. These guys are smart. You need a shock. You need a black swan for something to really happen. I think the market is telling us that, hey, the Fed is going to pause here. The Fed is going to pause here. The real question is, what do they say about freaking crude oil? Because I'm like, okay, wait, is crude oil, does nobody care? Do we not care about crude oil going up to 90, 92? Maybe that's not too terrible. I don't know. We'll see. We're not going up from here. If we were going up, we would have solid off the inflation report, sold off the inflation report. Okay, so the sell off and then the move higher. You think we're going to consolidate for a little bit? Yeah, here's the other thing. This is not a even market. Most people are offside. So even if we come down here to 438, there's going to be a lot of buyers scooping in. I think tech just starts taking off again. I think tech starts to run. And we're at the press. Like, here's the thing. Are we not looking at the VIX? Right? The VIX, finally bounced. It made a new low and then it bounces. It's still in the downtrend. The VIX is going lower and lower. There's more and more confidence coming into the equity market. You need a black swan, right? The move index. I know people don't really know what this is or really think about it, but it's making new, like, this is the lowest it's been since June of 2022. The move index is falling apart, meaning the collateral is stabilizing. And we talked about this maybe 2 weeks ago, where the treasury issuance, and this is part of the bond market, is starting to slow on the long end. Therefore, rates should not be moving higher, right? They should not be moving higher. They should get stuck here. And the bond market is responding by saying, okay, there's buyers coming in because the pressure, the selling pressure is slowing down on bonds. So the rates are slowing. That's what this is. This means more liquidity. This means more liquidity. This means the lower the move index, the higher the likelihood that people lend at a lower rate, more liquidity, more lending. That's sort of what that means. Okay. Credit risk, not happening. You're not getting credit risk. So I know people say, if the Fed pauses, we're going sideways. I think if we pause, we're going to rip higher. You're getting money market fund liquidity come in, right? On the 20th. Okay. It is the 20th. Inflation isn't going to return from here. Isn't. Okay. So what were you saying? Oh, okay, the bear flag. Let me see. Yeah, I'm not expecting a hike. I'm bullish. If we hike, we sell off hard. I think inflation trending down. That's and that little spike in inflation could be similar to a bear flag spike. That's what I think. I mean, if we literally go back, right? Let me pull up this chart. If we literally go back to the 80s, to the 70s, there's always these little bumps, right? You get these little bumps higher. Where the hell are my charts at? I just put all these inflation charts up. Oh, here it is. You get these little bumps higher, but it isn't necessarily a super bearish signal. So let's see, pull it up right here. Let's go full on. It looks stupid. All right. So yeah, you get these little spikes, right? I mean, on the way down, if we compare to like 74, on the way down, bump. And we had no bump, by the way. We just kept going lower this whole cycle. You get a bump, you get a bump. Now, this bump turned into a higher level. But why was that the case? And this is what I'm literally trying to point out today. The case was, well, damn, the Fed funds just got cut. They cut rates like crazy. Of course, that's going to refuel inflation. This was when oil was most of the economy also. Oil is not, I mean, yeah, oil is not the biggest part of the economy now, the way it used to be back in the 70s. This was the world economy, oil prices, right? Crude oil. That's not the case anymore. So it's not going to be as big of an impact. And the Fed is holding rates higher, not cutting. So again, do we know? The answer is no, but the probability is that this is a small bump higher. We're at what, 3.7%. Maybe we get to 4% because of this last surge. Maybe CPI goes to 7%, not 7. I'm sorry. Maybe headline goes to 4, from 3.7 to 4.1, and then it rolls over from there. Which is why we got to keep our eye on oil prices over the next really 2 months. Because what happens here, and I'm going to go here, what happens here in September is going to determine what we see. Where's the chart at? Here it is. What happens here in September, right? This is the bullish part, is going to determine what we see in November. And that's when the Fed has a decision to make. So far, damn it. So far, oil is up, right? For this month in September, so far it's up 7%. Last month, it didn't really do much. Last month, it was, see, here's August. Last month, it was up 3%. So that didn't make sense to me. We're only up 3%, but the CPI still moved higher. So maybe I'm confused about that. Maybe I don't know. So this would suppose we go to 4%. Maybe this is back to 4% CPI. Maybe that's the case and we live with that. But core is still falling. This is not going to make a big input on core. Core services, yeah. Transportation costs will still go higher. But hey, that's priced in. We know that. Duh. There's no surprise here. The market is looking for uncertainty to sell off, not necessarily certainty, right? Valuations are still suppressed also. Could be forming double top on VIX on weekly, on the VIX. I mean, yeah, the VIX is really just equities, right? It's just equities. So I don't think the VIX has patterns. I think they're absolute levels. The way I've learned about it, the VIX is about levels, not necessarily like trends. If you do, you look at the vol of vol. So if you look at the volatility of volatility, this one more you could do like trends, but for the most part, it's a level. And once you're under 20, volatility is coming down. Under 15, you really don't have much volatility. You're in a bull market, right? So we're still under 15. Once we get above 15, now you're in that transition period. Oh, wait a minute, are there risks coming into the market that we don't see? I don't know. We'll see. What else do we got here? No hike and pause for November and December. Yeah, I think that's the case. And again, look, I'm not concerned. It's not like I'm not concerned about oil. I am. I am concerned about oil going higher. Where's my RSI at? The hell? I am concerned about oil going higher. So, I mean, that's not the RSI that I have. Must have erased it earlier. Okay, so I'm a little worried about this, but we see that oil is oversold. I'm sorry, overbought. It's extremely overbought. I think it's a trade. I think it's a trade because OPEC is basically telling you we're going to cut. So is there really demand coming in? No, it's just cutting supply. Does that make oil prices go higher? Yes. But at the same time, you might lose more demand with oil prices higher. That actually should push demand lower. And you are heading into a travel season, so maybe it doesn't matter. Maybe oil does stick around here. Worst case scenario, oil goes back to 100. CPI is at 4.5. Where's core? That's your next question. Where's core? And what does the Fed think about it? That's the next question. Where the hell is core? And what does the Fed think about it? Because we do know housing is not going higher. Housing is rolling over. It's not going higher. It has nothing to do with oil. So as long as wages keep falling or stay steady, the job market eases. As long as housing comes down, I think the Fed is okay to pause at this point. Because if they keep hiking, they cause a recession. And at the same time, oil keeps going up. I don't know if that's a good idea, because if you take people out of a job, if you lower the productivity if you lower your productivity, then maybe that causes more supply side inflation. I don't know. It's tricky. I want to see what the Fed says, right? We'll see what he says. Going student loan payment resume in October. Regional banks losses continue to rise, and treasury's horrible. Yes. So the way I look at that, the way that we've been talking about this treasury supply, first of all, student loan repayments. A lot of people don't. I know people who are not even paying. They pay zero. They still don't have to spend because they either don't have an income, they don't really have an income, or they can they're using some servicing or some strategy where they don't make enough, so they barely pay. Like trust me, not everybody's. I know they say the average payment is 200. People are not paying that. They're not paying it unless they have a really good job. And if they have a really good job and they're making 70, 100K, who cares? $200 a month, not a big deal. I don't think it matters. If anything, what do? They just don't take that trip to California, which they're going to spend way more than that. So 200, I don't think is a big deal because most people are not going to pay that. And yeah, they're just not going to pay it. And I still expect the White House to push out more stimulus. I don't see a recession here, a full wide recession. All right, you need the business activity to go down. You need GDP back negative. I doubt it. I doubt it. And I thought we were, but this fiscal policy is just too much. Inflation Reduction Act, CHIPS Act, all that stuff. Where do you think the market is going short term? I would say the way that we're looking right now at the S&P. Now, crypto is a whole nother story here. The way we're looking at the S&P, it looks like if we remain under 444, it looks like and I actually like this setup. It looks like we're headed into the Fed meeting. It looks like we're going to go retest 438 heading into the Fed meeting, looking at these technicals, okay? Looks like we're going to go back to this support level into the Fed meeting, which I like the setup. I like the setup because what it does is it sucks in all these buyers waiting down here, and the Fed pauses. It's more positive, right? I like that setup. I rather head into a Fed meeting selling off than actually going higher. I think that's a better psychological setup because at the end of the day, the narrative is nobody really tells you what they want to do. They tell you what they think, but they're not you're not seeing what they're actually doing. And so most people are underweight. They're waiting for a big crash. If it doesn't happen, they scale in a little bit at 438, right? Let's scale in 5%. That's what they're doing. They're scaling in at these lows just in case this is the bottom, just in case inflation does drop and core gets below expectations in the Fed. So, in my view, this is a buying opportunity no matter what, right? Individual stocks, if you pick the right ones, which is probably the hardest thing to do in the market, that's where the opportunity really lies. Tesla is eating up the competition. Tesla at all-time highs by the end of this year. The fundamentals are only getting better for Tesla. They're only getting better for Tesla. For the overall S&P, though, it's not going to be as strong, but the internals, I mean, yeah, the Magnificent Seven probably continue to strengthen here. I think that's the case. You're getting a transition period here. So yeah, we might head back to 438 at the lowest into the Fed meeting, and then we'll see how the market responds to that. Keep your eye on the dollar. Obviously, if it breaks out over, when I've been saying this for now like 6 months now, we're actually here. I didn't think we are going to get here. Got played out over here at 101. Thought we were going lower. If the dollar gets above 106, it's going to cause havoc, and it depends how fast it moves. If you see the dollar move quickly, it is the wrecking ball. It is going to wreck everything. Everything's priced in dollars. So far, it hasn't made a big difference because it's slowly grinding up. So the dollar is all about speed. It's all about speed. If it speeds up, it's a wrecking ball. If it slowly grinds up, it's not a big deal. But if we slowly get above 106, it could be signaling something worse and we get away from rate risks. So here's my thing. The dollar moves up when rates rise, right? Bond yields. This has been pushing up the dollar. But let's say rates don't rise. Let's say the dollar keeps going up. The dollar is now turning into now the dollar is not being moved by interest rates. It's being moved by risk off. Somebody is saying, oh, hell no, let's get into dollars. That's my view. Forget the rates. We don't care about rates. Let's get into dollars. So the dollar is a couple things. It's not just one thing. It's a couple things, and you have to really think about the macro and really think about psychologically, what are people trying to do here? What's going on in the treasury market? So if rates don't move, I think the dollar may be signaling there's some geopolitical risk possibly. I don't know, right? But if you get a sharp move in the dollar, yeah, that's big risk off there. Nat gas still suppressed. This isn't doing nothing. No energy inflation. Also, you said in October, regional banks losses continue to rise. That's true. But what happened last time, Ace? Last time regional banks collapsed. And this is what the market wants to see, which is insane. Okay. What is Wall Clay, right? Wall Clay. I'm going to throw this on here. Wall C. This is the Fed's balance sheet. What the hell? So here's the Fed's balance sheet. What happened the last time that these regional banks fell apart? This was actually the bottom of the S&P. This is when the S&P was flirting with dropping back to the lows. Okay, we're flirting, dropping back to the lows. Here's the trend. We're right on trend. Right. Can I zoom in there? Yeah, a little bit. We were right on trend to collapse. And what happens? Banking crisis, boom, Fed balance sheet goes up. They cover the holes. They cover the deposits. Everybody is hoping for a 2008. It's just not going to happen. There's no surprises. Even if there is, boom, Fed steps in, right? So that's why I'm watching KRE for the KRE trend basically warns me, is the Fed nearing, is there some kind of black swan happening? If it does, expect the Fed to step in. You think the Fed's not going to step in? They are. They're going to step in. They don't want to collapse. They just need inflation to come back down, which they're getting. Not too quickly, but they're getting it, right? So yeah, that's my view on that. And treasuries horrible. Well, the thing about the treasuries, like I said, the RRP, right? The reverse repo facility money is going after those treasuries and capping the bond market. So we've seen rates go up and they keep getting capped, right? These are rates. Let me turn it into a line so you can see rates keep getting capped at this level. They should have broke out sharply. Maybe they do. Maybe they go higher. But right now, you got 30-year. You got 30-year capped. You got 10-year capped. You got 5-year capped. You got 2-year capped. I think the short end also stays capped more than the long end, simply because the short end offers better incentive, better yield than the long end at this point, right? 2 months, you can go 3 months out and get 5.5% for 3 months, and then you just refi. There you go, 3 months again at 5. So short rates are getting eaten up by this RRP liquidity, in my view. And so liquidity is here. The bond market, the bond volatility is falling, and it sets up for a strong second half, or at least fourth quarter. Who knows? I don't know. We'll see what the Fed says. I think the most important thing here, most important takeaway is, what the hell does Powell say about these damn oil prices? Does he care? Does the market care? Does this give you more earnings power? Does this contribute to earnings because oil is up? I don't know. Where do you think the market's headed in the short term? Yeah, Bukowski, that's what I would say. Shiva, can you go over the levels for Tesla, SPY, Meta if no hike for next week? Yeah, yeah, for sure. And I've been watching Tesla. I almost yesterday got in Tesla, but I was like, something's snappy here. It should have broke out. There wasn't a whole lot of volume in the intraday, and I was like, nah. So Meta, we did just go over Meta, and I'll quickly go over Meta really quick. Meta is basically, say there's no hike, the market goes higher. Meta is forming a wedge here. Okay, it's forming a wedge. Best case scenario, your breakout level for Meta is above 312, right? You want to get above 312. Obviously, that's the line. Let's throw on the simple moving averages. It's at the 50-day. So the breakout is there at 312, but it's pulling into the 50-day. You want to see this turn into support. Maybe it does. I'd say the best risk scenario for Meta is the market sells off going into the Fed meeting. You get support on the wedge, and you get support at the 100 daily moving average. And you have a little bit of support here too. You have these wicks at 275. So that's what I would say for Meta. At that point, you get that break above 312, and then the bigger break above 326, depending on how you trade. You also have some support here at 290. But it's wedging. It's wedging for the most part. You just want to watch the overall market. For what else did you say for SPY? S&P, the level's 444 for S&P, right? We're back below the 50-day. It keeps ranging between the 50-day, up above, right below. So it's in this wedge. It broke the short one, but we're still kind of wedging here, right? We're in this tight wedge pattern. It's tightening up. See it? Boom, tight, 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 tight. Maybe we go up and we just keep tightening until the Fed meeting. Or let's say we break down, we go to 438. That's my level, 438 to 436. It's not an exact level, but it's a range. And then maybe we just, we flirt with this. If the Fed does pause, you could still get a retest here, but it's more likely we bounce. It's way more likely we bounce. So you got 438 to 444. Remember, levels are not exact. There's no perfect level. It's a range. The range I have here is 442, 443 to 444. If it's above 44, very bullish. If it's below, I'm going to think more bearish if we're holding below that level for S&P anyways. For Tesla is very tricky. I want to see Tesla break down a little bit. If Tesla can get back to 260, which it could easily come back to 260, that's probably going to be where buyers start to step in again, somewhere around 260. You still got anchored VWAP in place here for Tesla. But it is kind of a bear flag. Here's the thing about Tesla. I'm watching the buying happen during the day, and these dudes do not want to slow up. They do not want to slow up. This is the buying pattern that I saw last time. The reason I held that. Why is this so thick? Oh, okay. Yeah, this is the kind of buying action that we saw back here. Right here. In the intraday. You can't really tell on the daily chart, but on the intraday, there's just a certain type of buying pattern where they just kept lifting. And this is why I kept staying long, because I was like, damn, these dudes they should have broke down. So you get a breakdown on a pattern and it shoots right back up. Or intraday, you're just seeing that it should be bearish, and it just doesn't stay bearish. It keeps forming these big moves on the upside. So for Tesla, your big level here is 275. 275 is the level. That is the level, 275. And then the next level, 260. Next level 250. I want to say 250. I'm not even sure if it's 250 to be honest with you. I would say if you draw a trend here for Tesla, if you draw a trend, you're kind of looking at, you really want to hold 260. I would say you want to hold 260 to some degree. You want to hold about 260 for Tesla. You're not getting a sharp pullback yet. If we do pull back into like 250, that might be a good opportunity because that's where the anchored VWAP is. Okay, let me kind of zoom in here. This purple line is your anchored VWAP, and you'd be breaking down and then get into the anchored VWAP at this level. So somewhere there is strong buyers though between 240 and 250 for Tesla. I was trying to get in at 241 and I missed it. It hit 241.97 cents and I missed it. But I would say, yeah, your best opportunity is to buy a sharp pullback while the market retains its value. Does it happen? I don't know. Other than that, over 275, I mean, it's starting to lift over 275. I mean, look at that price action. It's starting to look like it did back here. Trying to see if we see anything really similar. It's a daily chart. You can't tell too much. You have to look in the intraday. What else do we got here? Student loans will be a huge macro factor in 30 years when the interest rates double their loans for not paying more than a minimum. Yeah, I mean, shoot, who knows what will look like in 30 years though? 30 years, I mean, you might not even have interest rates in 30 years. When I say student loans might get evaporated, I think at some point one of these presidents are going to come in and everybody has the notion that the national debt growing is negative. It doesn't matter. It does not matter. The fiat system is literally you grow debt. The question is the interest payments. You need the interest payments to come down. You can always grow debt and your economy is going to be fine, but you don't want your interest payments larger than your productivity, larger than your GDP. That's where the real issue is. But debt always goes higher. Debt always goes higher. That's how you keep the system going. It's just the GDP. And it's just going to go on the Fed's balance sheet at some point. That thing goes higher and higher. People are like, what? So yeah, maybe 30 years, something bad happens, but I doubt we'll be in the same system. US crude oil. Let me see what we got here. US crude oil reserve stocks are low. Do you think they're buying more reserve stocks? And could this be driving up price? Good question there, Glenn Stevenson. I think oil, like really the bulls got this one on oil. The oil bulls got this one. The stocks are low. The US has to refill the SPR. My guess was there was more supply than demand, or there was more supply being put on than taken off by those other Iran, South Africa. I can't remember who it is. I was wrong. There wasn't enough supply to keep price down. It broke over 83.50. So the question for oil now is, has oil made its run? Has oil really made its run? Is this it? I mean, I don't know. Is this it? Is oil done? Right? Because even though China's re-stimulating, that doesn't go into their GDP necessarily. It goes into their capital markets first, which is why their stocks rose. So I really don't know this one. I'm going to keep, trying to look for more stuff. Of course, I want oil to go lower, but if we do get above this is that next resistance, 93 to 95, if we get above that, I really don't know what to say. I want to hear what the Fed says about it. It likely just keeps headline higher. It keeps headline higher, but also keep in mind, 50% of headline inflation is also, the screen, everything's on YouTube, bro. Somebody let them know everything's on YouTube if you want to see the screen. So here's the thing. Damn, what was I saying? Oh, most of headline is vehicles in shelter. So also you got to put that in, we might get an oil shock to the upside. Is it going to be as big as it did back here? Nah, I don't think so. I mean, if you get oil breaking out to all-time highs over 120, we're in trouble, right? We got other issues. There's probably geopolitical risk, but looking at the technicals, we're definitely overbought. Okay, we're overbought. We're coming into a big level at 93. People are going to take profits on energy at some point. As soon as that macro narrative starts to shift, we could be rolling over. Maybe the Fed even pauses and causes oil to roll over, not because they paused, but because other people are saying, okay, now the risk reward is better. Let's get out of oil. There might be traders coming into oil. Could just be a lot of traders pumping the price. You get a breakout, you get shorts covering, right? All that. So we'll see. We'll see where oil ends up. But I do think you need more productivity. Here's the other part. People think, oh, there's not enough oil. Trust me, there's enough oil. Somebody just needs to unleash it. The supply of oil. We need to drill more or whatever it is, or make a deal with OPEC. My guess is the US, that OPEC wants a deal with the US. Something to do with sanctions, something to do with better trade relations. That's what I think is really going on here. It's political. And they're trying to get the US to the table by choking them out by saying, we're going to keep cutting until you guys come to the table. Janet Yellen, watch out for her over the next month, over the next couple weeks to see who she speaks with. Because I think that's really what's going on here. Nobody wants higher oil. China's pissed. Everybody's going to be pissed. So I don't think it lasts. I really don't think it lasts. The only reason this happened is it was a war. It was a big shock. So I don't think it lasts. I've been wrong before, though. Maybe I'm wrong. Thoughts on buying Tesla at current price for long term? Oh, if it's long term investment, bro, Tesla's about to rip. No, if I were you, not financial advice, but if I were you, let's say you have a big let's say you have $1,000. I'm just gonna, it's easy. I would go in a third right now. I'd throw in a third of that right now, and I'd wait. If it goes higher, wait for a pullback, add. If it breaks lower, add another third. If it breaks lower, add, you're all the way in. And you're just, obviously, hopefully you're financially literate where you didn't just throw in everything you have, right? But if you do have a money you don't need, get a third in now. If it goes up, don't buy it going up. Wait for it to pull back 5 to 10%, buy some more. If it goes up again, wait for it to pull back, buy some more. Always wait for the pullback. And then if it breaks lower, you're going to add there. So I'd like to do 3 tiers. If it's a long-term investment, you have a lot of catalysts, bro. Tigger Media. You got Cybertruck coming online. You have full self-driving coming online. You have supercharger licensing. You have what else do you have? You have we have production coming up. Man, I just made a big list of all the Tesla catalysts, all the secular catalysts. Where did I put them at so I don't forget? 50% growth rate, margin bottoming. Maybe margins don't bottom because they're cutting prices, but the cost of the vehicle is bottoming, is coming down, and we're starting to get this slippage in the market with Tesla, where it's like, okay, everybody else is screwed, right? If they have to increase wages, there goes their business model. They already are at a loss creating their vehicles. Tesla's prices are dropping. Best-selling car in the world, Model Y. I mean, they have a lot of good catalysts here. Growth rates are up. Energy business is up. Who is it? Texas is investing in their energy segment. They're moving into India. There's just too many catalysts. Dojo, people are confused. Dojo is not just about full self-driving. Remember, he has Twitter. He has Twitter or X. So he has all that data to create another algorithm, probably for like a YouTube / Instagram social media type, right? So he has a lot of tools here. And usually Tesla doesn't get priced in what they're doing today. They get priced in what they're doing in 12 months. So that's why I say get in a third now if you can. As this momentum starts to pick up. If Tesla was going to sell off, would sell off? It would have Tesla is a monster spike, could sell off, and Tesla wants high. Yeah, Tesla's been moving despite S&P, which has been pretty interesting. Wonder if I could throw the compare up there. I think I can. Let's see. Well, let's check it out for ourselves. Over the past maybe like this chart right here. Look at or we'll do SPY. Looking at SPY here. Yeah, see, SPY's been pretty flat over this time period. And let's go from when Tesla broke out. So this is SPY and Tesla, right? Tesla, even the sell-off from the beginning. So from the bottoming of Tesla, I mean, it's outperforming SPY. SPY is pretty much sideways. Tesla's just climbing. So you want to keep that. That is breath coming into Tesla, or that's a signal that there's some real buyers coming in. Look at this price action. Like, look at that wedge, right? You get a wedge here, breaks out. Get a wedge here, breaks out. Now it's starting to wedge again. Could come back to 265-ish and break out again. Or maybe it just comes in here. We'll see. We'll see, but this price action is very strong for Tesla. Dojo, yep, you got Dojo coming online. What are you in? 114? Damn, this is a long. If there was, this guy likes Netflix, if there was no debt, the economy would be at standstill. Exactly. Debt fuels the economy. That's just the economy. That's the reality we live in. Debt isn't negative either. It's just what you do with the debt. The real issue is fiscal spending when it comes to the government, right? That's the real issue is the fiscal spending from the government. They spend it on stupid things. Depending on who's in there, it's like if you're going to accelerate the EV revolution or renewable energies, well, you don't stop spending on fossil fuels because you risk inflation. That's just common sense, right? That's just common sense. Forget how you feel or your politics. You're going to make inflation go higher. Oh, AMD looks good also. Yes, AMD. I like AMD. AMD finally came down. I know I took it off here. AMD did come down. Oh, AMD ripped back to the lows. This is really good. It's oversold now. What does it look like on the daily? AMD is looking really good. One more capitulation for AMD and could be ready to go. Yeah, AMD is setting up pretty nicely. But anyways, yeah, government spending is crap this year. No, not all of it. Don't get me wrong, not all of it. It's like Inflation Reduction Act. You're getting a $7,500 rebate, and most people, if you're not in Tesla or EVs, you're probably like, oh, that's stupid. But you're getting a rebate for electric vehicles. They're cheaper, way cheaper to charge. The technology is getting better. You get over-the-air updates. You don't have to go buy a new car every time a new one comes out. You get the over-the-air update. This is why Tesla will dominate. They'll be bigger than Apple. Who knows when? Maybe 3 years, 2 years, maybe next year. No, probably not next year, but they're going to grow. And really, it's going to come down to, in my view, where does the government choose to allocate capital for technologies, right? AI coming up. Blockchain's a big one that people are missing. I'm going to keep pushing out videos on blockchain. They don't really give me any views because it's kind of complicated, but BlackRock, biggest asset manager on the planet. Swift, biggest banking system on the planet. And we got some more updates from Chainlink. Swift, biggest messaging central banking system on the planet, all trying to tokenize their assets, their bonds, their real estate, their mortgages, everything they're trying to tokenize, and they need to not suck, but they need to plug in to crypto. The question is, what cryptos? We'll see. We'll find out. They need to plug into crypto to some degree, though, to make this happen, because crypto's innovation when it comes to tokenizing and moving assets on a blockchain are very advanced, where others are not. That's why CCIP is working for Chainlink right now. Again, this is more crypto talk, so it's like, what the hell is he talking about? Let's just put it this way. This is a 0 to 1 technology. This is not, let's copy something else. This is new, never been done before. If it works, you're getting cheaper, you're getting cheaper portfolio management fees. You're getting cheaper custodian. You don't have to use custodians. Like, blockchain removes all these stupid costs in the financial industry, increases efficiencies, increases your margins, and the whole sector improves. They're gonna have to plug in a crypto for that. What do you look for in what? Okay. Maybe you're in the wrong chat, bro. Might be in the wrong chat. Anyways, so yeah, that's the question here, and I think that's where we're headed. We're gonna see a lot of these, Amazon's coming out with its new business to business artificial intelligence for, what is this, advertising. Like, there's a lot of AI stuff. You got the boom early in late 2022 about AI, right? Was it like last November? Now it's gonna play. Everybody's like, oh, AI is washed up. It's already over. No, it's coming. There's still more AI to come on the danger zone and on the upside. My mistake, bro. I was like, what? That's the wrong chat. Anyways, yeah, any questions? I'm going to be doing the report tomorrow. I'll be on here live to kind of throw together the whole. What I do is usually I do a report tomorrow. Okay, there's a newsletter. If you just want to read instead of actually watch it, you can read it. You'll get it tomorrow. It's free. Link in the description, link in the bio. And I'm going to go over all of what's going on, because here's what happens. People hear one thing and they're like, oh, they anchor their bias to that news instead of anchoring their bias. You don't want to anchor your bias to one thing. You want to see all the context in the macro, on the technicals, on the fundamentals, right? Another thing people are forgetting, S&P earning estimates are turning positive from negative. They're not great, but estimates are going up, meaning the earnings recession is over. That's what we're guessing. The earning recession is over. Valuations can improve now. And if that's the case, that's a fundamental catalyst for fund managers, for professionals to buy into. They can't, like, people are going to be at risk to getting fired because they did not participate in the AI boom, right? NASDAQ's up 40%, NVIDIA's up 200%. They have no exposure. They're done. They're going to get fired. This is a competitive space. And if they don't get in, they don't take risks, they're in trouble, especially with the RRP liquidity coming in, especially with the Fed pausing, inflation coming down. Okay, yeah, oil's a risk. They're going to anchor their bias to that, but that, you got to take the whole context. So I'm going to give you that macro report, all the macros, what happened this week, what I'm looking at going forward, kind of the past, talk about it, and just stay tuned. Just stay tuned. I appreciate you guys. PI Network. Yeah, I know about PI Network. I heard about it in the past. I think it's trash personally. Maybe I don't know enough about it. Maybe it got better. I don't know. Fund managers are getting wrecked in the market after month over month. And mom and pop investors keep buying the dips. Exactly. They're trying to find reasons to get long. And I think that's what's happening here. Like, if I were to go over the whole thesis, here's what's happening. The market is based off of, are you overweight? Are you underweight? That's the direction that's going to go. If people are more overweight, the market tends to not move up as fast because everybody's already in the market. If you're underweight, there's more room for the market to move higher. If you're overweight, there's more room to come down. Then it is, where's the exact price? Are you at the all-time high or are you at the all-time low? We were at the all-time low. We went higher because people were underpriced, underweight, and then the macro improved. Right now we're flirting with all-time highs, but you still have more fund managers underweight. And you have FOMO that might come in, right? Because everybody wants to be exposed. And then at the same time, earnings are starting to revise up, opposite of what Mike Wilson said, right? Opposite of Mike Wilson, where earnings are going up. And then at the same time, inflation is coming down faster than people thought. Okay, headlines popping up. We'll keep our eye on that. We'll see what the Fed says, but core is coming down. Core is starting to come down now. And we know there's a lag effect and that should continue to filter in. Okay. On a technical basis, we're still in an uptrend. We're still holding the 200, the 100 daily moving averages. We're still holding the quarterly moving averages, and we're still holding the weekly 50 and 100 and 200 weekly moving averages. I believe so. Double check me if I'm wrong. Okay. At the same time, this is the big one. The Inflation Reduction Act, trillions of dollars, right? Inflation, infrastructure, and the Inflation Reduction Act, the CHIPS Act. Oh, the CHIPS Act. Those policies, that liquidity, fiscal liquidity, government spending, doesn't all come at once. It's not a big tranche. It slowly starts to like it's like it's a slow injection into those economies. So it's a stock pickers market. Who's going to benefit from that? Caterpillar, Tesla, blah, blah. I can go on for days, but I still think Tesla's the best bet when it comes all down to it. But what I'm saying here is there's a lot more upside catalyst. Everybody knows it. They're just waiting for the pullback, the rip lower to get in. So they're waiting for that rip lower to go in. Maybe oil creates that. Nobody's going to get super bearish on the entire market because oil's too high. That's not the case. Inflation is falling. It's not going up. Okay. It is falling, and you're going to get a couple bumps, and then it's going to roll over. It's worth $50 now. PI. Oh, maybe I don't know about PI then. I don't know. So that's my take on it. Mike Wilson, bearish as ever. Poor Mike Wilson. Maybe he'll be right. Maybe something happens. Maybe the consumer rolls over. I doubt it, because you're also in an election year, and I really, really don't doubt with this type of president, right, where we're at. If anything weakens, this dude is going to print money. This dude is going to send out checks to some degree. He didn't need to do it in 2021 when we already had checks. He did it again, right? Because people are going to vote for him. He's going to get votes, right? He's going to get votes, and they're going to try that. They always do that. So all this issuance, everybody's like, oh, it's so bearish. The Treasury is issuing all these treasuries. Well, what do you think happens? All that Treasury issuance turns into spending at the Treasury for the government to create more stimulus, to send out more, boost the economy even further. So you're going to keep getting that bid. 401ks automatically buying the market month after month after month. 401ks are always buying. You get an unlimited bidder with less selling because people are not. It's a setup for a bull market to continue to all-time highs. You need a black swan for things to go wrong. Oh, black swan, banking crisis, Fed steps in, pumps liquidity, eases markets real quick, and then tightens again. Okay, real estate crashes, Fed steps in, pumps liquidity. Well, why didn't they do that in the past? Because they never had it in the past. Well, the last cut was bearish. No, it wasn't. The last pause was 2018, 2019. It was actually bullish. But they cut and the economy fell apart because the pandemic hit. It was a black swan. That's my point. That's my point. Price expectation. I have no clue about Apple. Guessing what price will be is, to me, is a fool's game. You cannot guess what price will be in the next week. You got to look at the technicals, look at the macro, and know the stock. I really don't know. I'll say this: if the S&P 500 can keep up, Apple goes back to all-time highs. If the S&P breaks out, simple as that. I don't know exactly what I'm like trading advice for the next week. You have to know what you're doing. If you have to ask me, then I can tell you the levels, but if you have to ask me where the price will be, you probably shouldn't. You're probably not educated enough to even try to be trading. You got to learn. You got to learn. You educate yourself. You are your best investment here. You invest in your education. I have a lot of free stuff on the website. It's all free. I'm here streaming 6 days a week, pretty much, doing a newsletter a week, tweeting on Twitter. So take advantage while you can. Take advantage. I wish I had somebody to tell me or give me their insight on all that. Anyways, I'm out of breath here. I got to get some more videos ready. We got Tom Lee coming out this evening. Tom Lee, we'll hear his thoughts. I'll edit that video and send it out to you guys on the YouTube channel and on the TikTok channel. Other than that, you guys have a great weekend. Be safe. Don't do nothing stupid. Look at the long term here. Don't do nothing stupid. Look at the long haul. Invest in yourself. Be the best you possibly can be. Aim high, focus on the day. Get your sleep, get your nutrition, go work out. Don't be a lazy bum. Do what you got to do to improve every single day. Right? I appreciate you guys and stay blessed. Stay blessed. Every new investor always asks, what the heck does that sound? Oh, shoot. I was listening to Real Vision. It scared me. Let me read yours. Cheers. Yeah. All right, guys. Hey, you guys have a good weekend. All right. Yeah, I know carbides. I know. All right. Catch you guys later.